Hey, if you are looking to invest in alternative assets, multifamily is certainly one of the best ones out there. But you may be interested in something else. There's technology, there's oil and gas. And today we sit down with Sandhya Seshadri to talk through some of the other alternative assets she's investing in. If you want to learn about the depreciation benefits that you get from oil and gas or the appreciation opportunities that exist in technology funds, coupled with multifamily investing, this is a video you definitely want to check out. Check out today's show with Sandhya Seshadri right here on Multifamily Insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Sandhya Seshadri is the founder of Engineered Capital. Now, while she was working in corporate America, she saw firsthand how people dedicated so much of themselves to work while simultaneously missing out on crucial opportunities to protect and grow their wealth. That is why she started investing in commercial real estate and launched Engineered Capital. Let's welcome to the show, Sandhya Seshadri.
Thank you so much for having me, John, and kudos to you for having a podcast for this long. It's a very big effort to do it, and you add so much value to your listeners. So thank you for inviting me back to your show.
No, I appreciate it. Thank you for being a great guest and being a listener and supporter of the show as well. I mentioned you were on before. You're back on episode 536, a great episode where we talked about some tips to help you evaluate real estate syndications and investment opportunities. But for those folks who are not familiar with you and your background, I went over your bio at a very, very high level. Take 2 minutes and fill in some of those gaps.
So I came to the U.S. with 2 suitcases like any other immigrant to go to college here. And soon after that, I joined corporate America in an engineering position. Realized very quickly that business and sales folks make all the decisions in the business environment. And so I got an MBA in the evenings, working full-time, going to school part-time. And that's where I learned to trade stocks, etc. And after about a decade of working, I realized that I could trade and make just as much money as my W-2 staff. And so I was financially independent just from my investment. And that's where my investing journey began, had children. And so from a lifestyle perspective, it made more sense to be investing. And we then had a tax problem. My husband had a W-2. I was earning good thing with trading stocks. So I found my way to real estate, realized that single families just wasn't appreciating much in value in the Dallas area. And the cash flow wasn't enough to justify the, 4 T's that we dread, which is tenants, toilets, termites, and trash. And I found my way to a weekend event that taught me all about commercial real estate, where you buy these humongous large apartment buildings through syndications, where you only have to put in a very small amount of money. You leverage the debt and then you raise money from other people to make the down payment. And that's how I got into commercial real estate. I've been doing it since 2018. And most recently, I've pivoted to other asset classes as well, as multifamily got a little bit of a beat down from the rising interest rate. So I am right now invested in a variety of asset classes, including multifamily.
I love hearing your background, right? Because it's one, first of all, you tell a great, concise story. Like, I got your journey in that 2 minutes. So I appreciate that, the brevity and the clarity of how you describe your background, right? But you talked about coming to the U.S. for college, getting into corporate America, and realizing that the people who really get to make these decisions are the sales folks and the business folks. So you go and get your MBA. While you're doing that, you learn about investing, primarily focused on stocks. You start investing in stocks. You're making just as much money investing in stocks as you are in your day job, which forces you, or gives you the ability, I should say, to pivot and just become a full-time investor. While you're doing that, you now have another issue, a good issue, but it's still an issue, where you're looking at the tax situation, and that leads you to real estate. In real estate, you're realizing, hey, I'm not making as much money with the properties that I'm doing. They're not appreciating as much. That gets you exposed to apartment syndication. And from there, you really started to grow and do more, not just with apartments, but also other asset classes. You know, your story is one that you know, we hear from so many people when it comes into working in corporate America. And one, you didn't mention this directly, but you talked about starting a family and wanting to have more time freedom and time flexibility, and investing allows you to do that. It looks like you kind of got ahead of the curve a little bit, where you weren't stressed out to the max trying to do everything at once. You realized this investing thing was opening up the doors. Can you just take us back in time a little bit and share a little bit more about kind of your thought process when it comes to investing, particularly making that transition from stocks into real estate?
Yeah. So the stocks into real estate happened because we had a good problem to solve, which is taxes. Despite having an engineering background, I couldn't come up with some great product or innovative idea to start my own business. And so real estate was very natural and simple, I think, for all of us to follow. But when I evaluated single family, because I have a lot of friends who were flippers and who did single family rentals, I felt that the margins just didn't justify signing a loan and taking on all that debt and the responsibility, because I didn't grow up with a handy person background. I was really good with numbers, and spreadsheets are my friends, but not, handy construction. Let me do it myself. Let me, remodel my bathroom myself kind of background. So I was actually a little afraid of doing the construction side of business and repairs. And that's why I stayed away from actual single family. And I went straight into multifamily for that reason, because we can hire third-party property managers with on-site staff full-time doing all of this work, handling the leases, handling the repairs, that leaky toilet call that you get on Thanksgiving Day kind of stuff. I don't have to deal with that. That's what made this attractive. So if you have enough doors to where the revenue from that property can pay for having full-time on-site personnel, then you don't have to worry about doing these day-to-day tasks yourself. And you become more of an asset manager, running the show, managing property management, etc., and all the other stakeholders involved, such as the lender, the investor, etc. Very similar to the project management kind of role I had in my engineering corporate world. So it was a very good, symmetry and transition, using my skills from corporate to bring it into commercial real estate.
I love that you shared that, because I think that is a piece that so many people miss. When you think about real estate investing, I think most individuals believe that is becoming a landlord, right? Going out, buying a property, a single family property, and managing it yourself. Or even if you hire a manager company, you're pretty much just being a landlord, or you're being a flipper. You're buying a project, you're going to do some construction work to it, fix it up, sell it for a profit. And what you're talking about is, for most people in corporate America who understand project management, who understand finances and spreadsheets, running a business or operations from that perspective, a better or easier or just a different way of getting started is through syndications. And it's because it's run more like a business. It's more project management, it's merging teams, it's more systems, it's more organized, it's more of a team effort versus, when you're a landlord buying a house, there's not enough profit to share with too many people. I mean, you can have a property manager, you can have a handyman, but you're not going to have 4 or 5 partners on a house. I mean, you're going to make $20 a month, right? It's just not worth the effort. Versus, in an apartment syndication, you're talking about a larger apartment deal. There's enough revenue going around to pay people to actually work at the property, not just on the property, but like someone's full-time job is to be the property manager at that one asset. And that just gives you the ability to run it more professionally. And I think it's a smart way for corporate professionals in particular to start getting into real estate if this is something that can help you and your family with your financial goals. I know you talk to a number of people who are looking to break into the space or who are early into the space. Talk to me about some of the challenges or concerns that they have when it comes to getting into just real estate syndication as a whole, not even just multifamily, but just syndication as a whole.
So we all drive around town and see these humongous apartment buildings and always assume it's going to be some billionaire like the Trump kind of people can afford them. And I had no idea that everyday ordinary people like us can go and buy it. Just like you buy a fraction of shares of Amazon, right? You own 10 shares of Amazon. It's a zillion dollar company. It's similar to that. You buy a $20 million apartment complex, but you only put in like, let's say 50,000 of your own money. And then you pool your resources and money together with, let's say 30, 40, 50 other investors. And together, maybe you put a down payment of $7, $8 million. And then the rest of the money comes from a big lender. Just like you finance your house with a bank, you get a lender like Fannie Mae, Freddie Mac, or a CMBS bridge lender to fund the rest of that project. That's how you go and buy a $20 million building. Just like you buy a $300,000 house, similarly, you have the down payment funded by you and your pool of investors, while the big check is still written by the primary lender who predominantly owns the bulk of the property. So part of your role as you're the operator or the general partner is to maintain those lender conversations, relationships, city, etc. But if you're the passive investor, just like I'm buying Amazon stock, I'm not Jeff Bezos and his executive team making decisions on the company. I am just owning a fractional share, and I'm happy to leave it there and hope it appreciates in value a few years later. And then when, in the case of an apartment complex, they have done their value add, the general partners, that's an example of the pilot in a plane or the executive team of Fortune 500 company. They make all those decisions. They've done their execution of their business plan. Then they sell the property, and that's when we make money as passive investors. And that was an easy way for me to get into commercial real estate first, passively, because I then get to kind of watch what goes on without me taking on all the risk, without me suddenly having to be responsible to the lenders and all the other stakeholders. And I invested in properties in my local area passively, which allowed me to drive to those properties, meet with the sponsors who are the ones running the show, and learn from them, and then slowly get the confidence to then take on that role myself later on. But that's how I transitioned as first as a passive investor, which is, before you become a pilot, go be a passenger on a plane, know what it feels like to just be in an airplane, hide for a few hours before you say, I'm going to suddenly be the pilot of America that's been driving the jet, from, across the pond to London or something. So passenger in a plane first, then maybe a co-pilot, which is what we call a co-general partner, where you're still under the leadership, mentorship of someone with more experience. And then you become a lead yourself and you bring on other people. So that's what I do now as a lead. But when I started out, it was passive, co-general partner, and then lead.
I love that trajectory, right? You talked about really starting off passively, and for you, it made a lot of sense, right? You were coming in, you had your stock background, you had your business background, but you wanted to entrust another team, right? Let a sponsor, let someone else with more experience run it. And you said something that was really important. And I don't know let me ask this question first, actually. Did you know from your first investment that you wanted to be an active lead in the future, or was that something that just kind of morphed naturally?
It happened naturally. It was something I was definitely interested in, and I had so many ideas, etc. And I was like, getting on the active side would be really good as well, because I was, again, a full-time stay-at-home mom trading stocks for a couple of hours every morning. So I definitely had the time, and I was learning this. I was like, hey, this is even easier than the complex engineering projects I had to manage. I could do this. And then what also happened was, in my very first deal I got in with experienced partners, COVID struck at us. So it was like 2019, we acquired it. March 2020, COVID happened. So my partners traveled and they were both out of state. So even I was going to be just the eyes and ears for them and executing the plan as per their direction. But I ended up learning a lot more because I was the sole person who could travel to the properties, keeping that 6-foot social distancing and learning. And so I kind of learned the project that way. And I was like, okay, this makes a lot of sense. I can run a property like this. I know exactly what it needs.
That's great to hear, right? And the reason I was asking the question was, for many folks, one of the great things about being a passive investor is you can invest anywhere. You can be in California, you can invest in the West, you can invest in the Southeast. So it doesn't have to be in your backyard. Your case, you were investing in your backyard. And one of the perks was you were able to go to that property. And as you talked about, when COVID hit, that became more than a perk. It was like, hey, you know what? Sandhya's there. Can you go to the property and check this? Can you look at that? Can you make sure this is there, right? And you were able to really add value to the team because you were local. So that is not always the norm. And quite frankly, most of the time as operators, we do not want you to go out to the property to do those kind of things. You can check it out, take pictures, look at it, but we're not asking you. It's not a requirement, right? It's going back to your example with being owning fractional shares of a company. Jeff Bezos is certainly not asking you to come down to Amazon and weigh in on any of the meetings that he has, right? So like, they're not inviting us to come and weigh in and give our 2 cents. It's like, hey, you're going to invest. You're going to ride the wave with us. We're going to make sound decisions. But one of the things that I always love about investing in commercial real estate, particularly with syndications, is you do get a closer relationship to the lead group. You know what I mean? Like, I could buy Amazon stock. I promise you, Jeff Bezos is not picking up my call. You know, he has no care about anything I want to say, any ideas that I have. Like, they don't care, right? But you and I are working together on a deal. If I invest in one of your deals, I could call you. I can ask you questions. I could say, hey, what are you thinking about this? Same thing with me, right? You could call me and say, hey, John, I'm thinking about this, or what are your thoughts here? And we can have that conversation. And again, I'm not being responsible for the outcome of it, but if I have an idea or I have a question, I can reach out. And I know a lot of people like kind of the ability to touch the investment, to see it, that it's physical, that I can reach out and call the person making the key decisions. And I get a much better sense of who I'm investing with, their business plan, their character, their values. When you're investing in stocks, you don't really know a lot of these leaders. Sometimes those leadership changes and the company you thought you invested in is no longer the company you're a part of. So a lot of things can change there. Speaking of change, obviously the market has changed drastically over the last 3 or 4 years, particularly when it comes to some of the markets. You are primarily in Dallas, and I know you started to pivot your investing strategy. Kind of walk us through that transition, right? What was the market like for you a few years ago? What is it like today? And where do you see the outlook moving forward?
So when I started out in commercial real estate in 2018, the market was really great for CRE. We call it the golden era of multifamily, because anything that you bought back then and then sold by 2021 or early 2022, you made excellent money. And it didn't matter how well you operated the deal, because the interest rates and cap rates were compressing so well that any deal made money. And that was a golden era, made good money on those first few deals. And that was fantastic. But then I also acquired deals in 2021 and 2022. And some of those were in floating rate bridge loans, which thankfully I was able to refinance last year. But what happened was your mortgage payments basically doubled. Even when you bought a rate cap, you had initially thought the interest rates were 3.5%. And then it went up to like 6%, which is typically the range of the rate caps most of us bought. So right there, your mortgage payment went much higher than you had planned. Taxes went up quite a bit in Texas every year. We always have to battle that. And then insurance went up in a lot of areas overall. And so all of that basically was like an uphill headwinds that we had to face in commercial real estate and multifamily in particular. And a lot of deals didn't do well. And so the newer deals that we tried to underwrite also did not quite provide the cash flow that investors were looking for. So existing deals acquired, even on the passive side as well, the active deals, didn't quite have the double-digit cash flow that we saw in the golden era. Like, I would close my eyes and distribute like 10, 11% to investors in my earlier deals. And I'm struggling to get to that 7, 8% nowadays. It's more like 3, 4, 5% kind of cash. So that just was so much like, it was like you're trying to squeeze water from a rock, kind of really, really hard to find any meat on the bone in a lot of deals because of the expenses going up so much. And rents also started flat. And so if your income kind of flattens and plateaus and your expenses keep going up, that's squeezing into your profits. And that's what happened with commercial real estate. So I had to pivot and find other asset classes to attract my investors. And being a strong technology background and really understanding the future of technology, I got into technology funds again, just like I did with commercial real estate, first on the passive side. And so I did 2 rounds of those, and those have gone really. So now this year, I am actually also raising capital and bringing investors these exclusive technology opportunities that typically only are available to venture capital. So quite a few of my investors are engineering background. They like their numbers. They believe in technology. So because of that, it made sense to open this opportunity to them. And the thing about technology funds is there's not much cash flow at the beginning, but there's a really big upside at the end. So it's perfect retirement funds which you're not counting on in the next 5 to 10 years to give you any cash, but it's a really nice upside. So that people who like that upside potential, it's a perfect fit. The other thing I've been doing is oil and gas. Now, crude oil prices, just like the stock market, took a hit when Trump announced the tariffs in early April. But what you have to model it is for what is your break-even cost? Just like with multifamily, what is my break-even occupancy? Same way with oil and gas. What's my break-even price at which I can still be profitable? And I've invested again passively in several deals since 2023 in oil and gas. They've done really well, which is why now in 2025, sharing that opportunity with investors. I always like to test the waters out myself and take all the financial risk first, personally, with specific operators and make sure I can vet everything out to a deeper level before I dare to ask and bring other people's money in these deals, because they work very, very hard for that money. And it's one thing to take risks with my own capital, it's a whole different ball game with other people's money. So you got to be really careful. So I took my time since 2023. One of those deals is close to getting all of my invested money back in 24 months. That was a big one. People in commercial real estate, all the things I went looking for, which is a tax savings, cash flow, and appreciation. I'm getting all of those now with oil and gas. But again, you need to look for that crude oil price. You need to make sure. You hear a lot of rumors about Ponzi schemes and people just running away with your money. So how do you verify that? So in commercial real estate, we have a property that we can go to the county records. We can verify title. Similarly with oil, there's wells whose records, again, you can verify at the county level. Another risk with oil and gas is that you might get into a dry well if you're just drilling blindly, right? So we only invest in mineral rights, the rights to the oil that's made there after they've started the drilling. So we verify that the wells are producing oil before getting into it. So that takes some of the risk out. Of course, that also takes some of the profits out, but that's our comfort level with the risk. We also want depreciation because that's something my investors like to see, which is a tax benefit. So if you invest, let's say $100,000 into a deal, whether that's commercial real estate or oil and gas, you could get a tax write-off. In oil and gas right now, we're getting a minus 80K K1 paper loss statement, which could be used to offset any income. Now, in commercial real estate, unless you're a full-time real estate professional designated by the IRS and qualifying doing those activities, you may not be able to write all of that off. You may only be able to offset your passive income with passive losses. But with this oil and gas, you could write off the entire amount. So 100K investment gets you, let's say, a minus 80K in your K1 statement. You could use that to offset, like in my case, my husband's W-2 income or my own gains from the stock market. And that's very, very beneficial. You get it for the first year. So we look for deals that offer that 80% tax benefit without any recapture. So what is recapture? 5 years from today, if I sell my commercial real estate building, the building still exists. So I have to recapture all of that now because somebody else is going to come in and take that benefit in that building. In the case of oil, you've already spent all the effort and money on drilling and mining costs, etc., depletion, etc. So there is no recapture. So you don't have to hunt for a 1031 or another deal to immediately get into. And sometimes you make the mistake of, I've got a deadline, I've got to get into another deal within this time horizon. And sometimes you get into a bad deal. You don't have that. Now, everything carries its own set of risks. So it's very important for you to figure out, does this investment meet the goal? And can I take on this risk? Like venture capitalists trying to bid on a technology fund where you don't see any cash for 5 years. That's not for everybody. And similarly with oil, it's drilling, it's mining, and how comfortable do I feel? But I think with any asset class, whether it's real estate, it's a building, it's a oil and gas, it's self-storage, etc., understand it, study it, put small amounts of money, as with any investment, that you're willing to lose. Because any investment can lose your money, whether it's a stock or anything else. And then once you study it, you understand the risks, you're willing to tolerate them, then you get into it. Because some of these really have asymmetric returns, great potential. But again, that risk-reward ratio is something you really need to understand with investment.
I really appreciate you breaking that down. You talked about the technology funds, you talked about oil and gas, and getting into some of the pros and cons. And many of our listeners are likely not as familiar with how to invest in oil and gas. So I appreciate you breaking down that, hey, there's mineral rights where they've already found the drilling and there's already oil there versus, hoping that they find oil. And I think of that almost similar to, when I think of commercial real estate, it's the difference between investing in an existing asset versus new construction, right? And just buying land and, hey, we're going to build this thing and here's the plans, but you're hoping and obviously you're waiting for them to build it and execute on that vision versus buying an asset that already exists and is already producing that product there.
Exactly.
And you said there are a couple things, right? So one, you mentioned oil and gas with the crude oil prices. That's something you got to pay attention to. At a high level, for someone who doesn't understand, me included, at a very basic level, like, how does this work? I get in real estate, right? With commercial real estate, there's a tenant typically that's paying rent of some sort, and there's certain expenses you have. So whatever income you have minus the expenses, that's the NOI. If you have any debt, whatever's left over, that's the cash flow. That's how you make profit, right? But it's all stemming from the rental income. With oil and gas, what's the income? Like who's buying it? Like how does it actually work?
So we are buying the right to the minerals and the ability to drill, and a piece of that drilling revenue comes to us. We always pick large operators like EOG as an example. So they have spent millions and millions, your Exxons, your Chevrons, etc., are all drilling in those same places. Just like you and I have identified certain target markets where we will go invest in real estate. We're not putting our money into California unless we have some Section 8 or some form of payment. We're picking these landlord-friendly states. Same way, there's locations all over the U.S. map where there's tons and tons of research done and oil being produced. And so we go only to those zones, those regions where millions and millions have been pumped by these big companies. So we're not taking a risk of figuring out, is this market great? It's already been figured out for us. And we're getting a small slice of all the drilling that's already going on there in that area. So we know that that location is producing, and we don't like to put all our money into one well. So we like to buy the right 6 wells or 8 wells, etc. And so we know there's already wells producing oil around there. And so we get into the deal a little bit later in the stage. It's sort of like buying multifamily after it's been built and renters are paying rent. Same way, we like to get into these after we've found some oil there. And the nice thing is that if crude oil prices go up, hey, the production's full swing, man. We're producing as much as we can. But let's say it crashes below our even number. Our break-even number right now is about $37. But around COVID time, it did crash and then come back up. So if it only crashes briefly, that's fine. We can handle it. But let's say it stays down at, $25 or something for more than 6 months. Hey, that means I'm in negative cash flow in a way. So you slow down your production because you don't want to sell as much when the price is that low. What does that do? Then that constricts your supply. So then the prices go up, and as prices go up, produce more so I can sell more at a higher price. So you're producing oil, and that's your source of revenue. The oil price therefore dictates that. And your drilling costs, etc., is your expense. And you get to deduct that for taxes in year one. And then we actually start you out as a GP, general partner. So you do take on some of the risks and liabilities. But from year 2, you become a limited partner. And that's the way that we're able to give you those tax benefits for that year 1, which is about 80%. So that's how it works as far as the drilling. The other unknown that you don't know, even in our case, is how much volume of oil is each well going to produce. So usually their peak production is within those first 6 years or so, from year, 6 months to year 6. So we typically say that by 24 months, you should be able to get all your original principal, assuming again the crude oil price stays at a certain number. And then in another 2 to 2.5 years, you get another exactly 100K back. Let's say you invested 100K at the beginning. So in about 7 years, you should get about 2.5 to 3x your money. So that 100K should come back to you as 250K by about year 7, maybe more. And again, that depends on crude oil prices and, of course, the volume of oil you get from each well. That's why we don't want to invest just in one well. And that way we get several wells to sort of distribute our risk.
Yeah, certainly lots of things to dig into on that, right? If that's something that's of interest to you, I implore you to reach out to Sandhya. She's got a ton of information in this space. And it comes down to, diversification, understanding what your goals are, what your criteria is. If you really need diversification, or I should say, if you really need depreciation, you want to get out of, commercial real estate, or you want an alternative to commercial real estate, oil and gas could be a really interesting opportunity for you. And alternatively, as you mentioned in the tech funds, if you're really looking for those big swings, looking for opportunities to drive appreciation, not necessarily focused on cash flow, but big time appreciation, investing in tech funds might be a great opportunity as well. So it's really just understanding, where are you with your investing? What are your goals? What's your criteria? What's your time frame? What's your risk tolerance? And based on that, you can make some really good investment opportunities. If you want to learn more about that, please reach out to Sandhya. You can connect with her on LinkedIn. We're going to make sure we put a link to her page in the show notes below. Right now, we're going to transition and go to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the mastermind button today. Sandhya, give me a failure or an apparent failure that set you up for later success.
So commercial real estate really took a big hit when the interest rates started going up. So we had to hone in even more on operations than I have in the past. So I'm finding little things like half the stuff we order doesn't have to be ordered from the same supplier. You could go get it from Amazon, or you could just make do without updating it. Like, it's fine that my refrigerator stays white or black in color. Not everything has to be a platinum finish and stainless steel. Is the resident really going to appreciate it and pay me an extra $100 just for a newer appliance versus let's leave the rent as is. Let's keep those units fully occupied. So asset management has always been my focus, just like project management in the engineering world. And that's becoming very obvious, but it's also a lot of work, which is why I wanted to pivot to those other asset classes without having to do so much of the work.
Give me give me a digital or mobile resource you recommend for our listeners.
So a digital resource, if you don't already use it, is some way to manage your calendar. So whether that's Calendly or something else, guard your time very carefully and be careful about who you give it for. The pick your brain kind of calls, I stopped doing those. It's more of, I'm going to be at this meetup. We can meet there and chat, but anything else, you have to book an appointment with me only because we have some business to discuss. That's of mutual benefit.
Give me the book you've recommended or gifted the most in the last year.
The book I gifted the most is one where I'm a co-author. It's Lessons from Thought Leaders. It's got a chapter each from hugely famous authors. Brian Tracy, Dennis Waitley, Bob Berg, the Go-Giver author, and numerous other famous authors. I was privileged to write one chapter in it. It's Lessons from Thought Leaders. It's a very interesting short story style of Q&A, style of insights from different people. So hopefully at least one of them will inspire you.
Give me a daily habit. I love it. We'll make sure we link to that as well. Give me a daily habit that helps you stay focused on your goals.
I start my day by planning my entire calendar around the most important things that must be done that day. So whether that's, I need to make it to my son's, Taekwondo, event, or, oh my gosh, the lender needs this from me and I have a deadline coming up. Let me not miss that. Whatever is going to stress you the most, that's going to keep you up at night, make sure you address that first, because when you're calm, you function at a much higher level.
Give me your number one insight for investing in alternative assets.
Understand the risks, understand your tolerance, and only invest with money that you're willing to lose, because that's the reality of any asset.
All right, you are in Dallas. Give us your favorite place to grab a bite to eat. And I'm going to pull up your answer from the last time to see if it matches, just for the record.
Oh my goodness. I like neighborhood restaurants rather than big chains. So I like to support my neighborhood restaurant near the University of Texas at Dallas called The Fifth. It's a nice fine dining restaurant.
The fifth sounds like a great option. That is not what you said the last time, though. Do you have any guesses?
A fondue place, maybe?
You said Uncle Julio's.
Oh, Tex-Mex, of course. If you're in Texas, you've got to have Tex-Mex. So there you go. I guess I'm in the mood for fine dining today.
There you go. You know what you're doing for dinner.
Right.
Oh, well, Sandhya, listen, I always enjoy talking to you. You gave us some great information. A couple things stand out from your story, right? First of all, going from, college to corporate America, getting into stocks, recognizing you had a tax issue, turning to real estate, but also recognizing that you really didn't want to deal with those 4 T's, right? Toilets, termites, tenants, and trash. So you ultimately decided to go larger into apartment syndications, first as a limited partner, then as a co-GP, and then making yourself the GP or the lead operator. From there, recognizing, you know what, this is a lot of work. We're certainly growing and doing this, but there's other asset classes and other investments that can help address some of these needs a little bit better. And as we get more nuanced as an investor, that gives you the flexibility to really identify which investments help you. You move forward in that tech fund, oil and gas. And I appreciate you breaking down oil and gas because I've heard of folks investing in that space, but I really didn't quite fully understand how it works. So it's great to hear you break it down in that capacity. And the other thing that I take away is just that fractional share. I think a lot of times as investors, as entrepreneurs, as business owners, even as corporate professionals, we feel like we really have to understand everything, right? We got to know something through and through and be able to run the business like as if everyone else is going to die and you just got to be by yourself. And that's not the case. A lot of investing can truly be more of a fractional share ownership where you are simply putting your money to work. You certainly want to understand the risk profile of what you're investing in, but you're putting your money to work. They're not asking you to go out there and run this business. You want to invest with groups and teams that have the experience, they have the know-how, they have the track record, and they have the team in place to go out and execute. That's a great way to invest, to minimize not just your risk, but how much you're willing to put your time into this investment, particularly if one of the reasons you're investing is to have more time freedom in what you're doing. If you want to learn more and connect with Sandhya, she's very active on LinkedIn, has some great posts. You can connect with her there. We'll put a link to her page on the show notes, as well as our last conversation with her back on episode 536. Sandhya, thanks for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.